get to a situation where people start to see silver as an interesting investment, it could go a lot higher. And I think we've seen some possible signs of that in the last week or so. We saw the price break through $35, and I put out a post within seconds of it going through the $35 mark. And I basically said, silver's just broken through 35. That was a trigger point for many traders, and it could easily go to $36. And I just look at the screen now. Oh, good heavens, we're above $37 today. So it's moved fairly fast in the last few days, and I think that it's likely to go above $40 in the coming week.
Technology journalist Clive Thompson, who regularly examines how technological advancement shapes human behavior and culture, predicts silver will breach $40 within weeks, citing a 30-page AI report projecting moves toward $45 this year and potentially $50 soon after. Silver has already surged 24% in 2025 and 23% year over year, clearing $36.89 resistance with strong momentum toward the $40 level. The bullish outlook appears well-founded, given silver's recent performance and underlying market dynamics. Silver has surged 23% year over year, successfully clearing the critical $36.89 resistance level and now targeting the $40 threshold with robust technical and fundamental support. The metal has already posted impressive gains of 24% in 2025 alone, reflecting growing confidence among investors and industrial users alike. At the heart of silver's bull case lies a fundamental supply-demand imbalance that has been years in the making. Thompson explains that silver mine production has been steadily declining, while industrial demand, particularly from the rapidly expanding electronics sector, continues to accelerate. This structural shift began taking hold approximately 2 to 3 years ago, when demand first overtook supply, pushing the market into what has become a sustained deficit scenario. The numbers paint a compelling picture of market tightness. Industrial silver demand is projected to exceed 700 million ounces in 2025, which would mark the 5th consecutive year of supply shortfalls. In 2024, silver industrial demand rose by 4% to a record 680.5 million ounces, representing the 4th consecutive annual high, driven by ongoing structural growth across multiple sectors. Global silver demand once again exceeded supply that year, resulting in a structural deficit of 148.9 million ounces. The cumulative impact of these deficits has been substantial. Over the 2021-2024 period, the combined deficit reached 678 million ounces, equivalent to nearly 10 months of global mine supply in 2024. This mounting shortage has created the foundation for silver's current price momentum and suggests further upside potential as the market continues to tighten. Before we get started, don't forget to subscribe, hit the bell icon, and share this video. Your support keeps us bringing you sharp insights on gold, silver, and the financial markets.
At the moment, the supply of silver coming out of the silver mines is declining, and the demand for silver for industrial use, in particular the electronics industry, is rising. About 2 or 3 years ago, there was a crossover between the supply and demand such that we went into deficit silver. So the difference between the two is now being supplied, the shortage of silver is now being supplied by recycling. And if you want to continue to, that deficit in silver is going to continue to grow basically as far out as the eye can see at the moment, because the mined silver is not likely to go up according to the projections. It's been falling for many years and it's still likely to fall. So the difference has to be supplied from somewhere, and that surplus silver has to come out of recycling. And the only way you get people to recycle their silver is through the price mechanism. Put the price up and more people sell a bit of silver. There'll be traders, there'll be people who hold silver bars, there'll be people who sell silver ETFs. Price goes up, they'll sell a bit, and the thing gets back into balance. But what if we get to a situation where people start to see silver as an interesting investment? It could go a lot higher. And I think we've seen some possible signs of that in the last week or so. We saw the price break through $35, and I put out a post within seconds of it going through the $35 mark. And I basically said, Silver's just broken through 35. That was a trigger point for many traders, and it could easily go to $36. And I just look at the screen now. Oh, good heavens, we're above $37 today. So it's gone. It's moved fairly fast in the last few days, and I think that it's likely to go above $40 in the coming weeks. In fact, I'm just looking at. I did an AI search on silver this morning, and let me just read you what that said, if I can find it now. The present price performance indicates that it should be moving above 40 and perhaps on the way to 45 this year, and within not too much time, a $50 is possible.
Yeah, my question about silver also, how big is the disconnect between the physical market silver and the paper market silver?
Of course, there are plenty of traders who are using the paper market, the COMEX, to trade silver, but we've seen in recent weeks unusual deliveries, or recent months, I'm talking about this since the 1st of January this year, unusually high deliveries of both gold and silver, where people are saying, rather than rolling over their contracts, they're taking delivery of the 5,000 ounce bars. These are pretty heavy things, and they're worth a ton of money. So it's not mom and pop taking delivery. So someone's taking delivery, and the more delivery which is taken, the less that paper market becomes liquid for those who want to sell short. Because if they're selling short, they're only selling short because they believe they can lay their hands on silver when it comes to deliver, or they've actually got it somewhere stored away. So I think that my feeling is that the paper market is getting thinner, and that might be a reason why the silver price is rising. Of course, I have no physical evidence of how big the shorts are. There's a lot of talk about it, but nobody's actually been able to pin it down. There's no statistic you go and look at and say, oh, someone out there's counted the shorts, because these shorts, they could be bullion banks, they could be hedge funds, they could be private investors, they could be governments trying to suppress the price. But none of these figures are published by anyone. And therefore, you can't actually know when you see the trading on COMEX or anywhere else how much of it is naked shorts and how much of it's covered shorts.
Clive Thompson highlights a critical market distortion. The gold to silver ratio recently hit 105, meaning 1 ounce of gold bought 105 ounces of silver, far above the historical norm of 15 to 20. The current ratio of 92.62, while lower than the recent peak, still suggests silver remains significantly undervalued, or gold overpriced. Historical precedent supports this view. The natural ratio of silver to gold in Earth's crust is 17.5 to 1. Ancient Romans set their price ratio at 12 to 1, while the United States legally fixed it at 15 to 1 in 1792. France followed with 15.5 to 1 in 1803, establishing centuries of consensus around these metals' relative value. The ratio has fluctuated dramatically in recent years, ranging from a 5-year high of 105.85 to a low of 63.14. Even at current levels, the ratio remains 3 to 6 times higher than historical norms, suggesting substantial room for silver to outperform gold. Thompson's ratio analysis reinforces silver's bullish case. A reversion to even moderate historical levels from 92 to 40 to 50 would require significant silver appreciation relative to gold. Combined with existing supply deficits and industrial demand growth, this ratio distortion positions silver for outsized gains as market forces restore more traditional precious metal valuations. Let's get back to the video.
Historically, the ratio between gold and silver, we go back a long time ago, was something like 15, 20 times, I'll call it 17 times. 17 ounces of silver bought you an ounce of gold, or an ounce of gold bought you 17 ounces of silver. Now, very recently, a few weeks ago, ounce of gold would buy you 105 ounces of silver. What does that mean? It means either that silver is massively undervalued, or that gold is overvalued. And I take the view that gold is not overvalued. I think gold is undervalued given the growth in global debt. So I think gold undervalued. So let's just take gold at fair value, and we could have bought 105 ounces of silver. Well, if we were to get back to, let's call it 100 ounces of simplicity. If we were to get back to 20 ounces of silver, that means the silver price has to be 5 times what it is now. So you can see how far silver has to go to get back to some sort of normality. Now, I don't think there's anybody who realistically expects we're going to get back all that way back in short order, but there's a lot of room for silver to move upwards in the near term, and it could move a long way. And I don't know where the end lies, but I think we're north of $40 is where it goes. There are sectors which look particularly attractive. I think the mining sector across the board, but especially gold and silver, looks attractive. The reason for that is the price of gold and silver are both much higher than they were. The analyst forecasts were made some time ago, in each case, at the time the company reported its last results. Analysts tend to not stick their neck out and leapfrog each other too much. If they do leapfrog, they leapfrog a little. So for most gold and silver mining companies, we don't have any new reports which were made around the current prices. If you factor in the current prices, you'll find that many of these companies will, next year, based on prices which are much lower than today's, be on price earnings ratios below 10. So growth with a ratio of less than 10. That means they're going to be cheap and they're going to be showing growth if the price stays where they are. So I don't think either if the price of gold and silver just holds where it is and doesn't go up at all, those gold and silver mining companies, in my opinion, will be looking much more attractive to investors next year than they think. Gold always had a place in portfolios, although for many, many decades, a couple of decades, it was almost zero. But I think it's coming back. I've seen a number of banks write to me and say, we're now moving gold into our preferred asset class, or we think the gold price will be higher. I see forecasts sort of moving towards the $4,000 mark. They're usually quite cautious, usually at any point in time forecasting $100 or $200 above the current price. But there's a few out there who are looking at $4,000 this year as a possibility. Of course, if the gold price does rise, they'll raise their forecast. But the important point is they are now writing about it when they weren't 2 years ago, a year ago. And they're writing about it because they want to encourage their clients to have some gold. And we're talking about exposure of 1 to 5%, as opposed to having 0% gold. I mean, I can think of one very large bank here in Switzerland where if I spoke to the wealth managers who work there, the investment managers, and you said the word gold, they said, you should have 0 in gold. Why should you have 0? Well, pays no interest, it's going nowhere, it's a pet rock. Well, they're changing their tune, and that's officially changing the tune. Now you should have some. And why should you have one? Well, the reason they say is it's an alternative to the fixed income portfolio, or fixed income part of the portfolio, because it's likely to outperform the government bonds, for example, because government bonds are going to face a crisis down the line because the need to borrow is growing faster and faster, and salaries and incomes is not growing fast enough to create that. So we're going to have less people being expected to buy more bonds, and that means the price has to...
Gold remains firmly supported by rising global debt and economic uncertainty, while silver lags far behind its historical relationship to gold. With the gold-to-silver ratio stretched to extreme levels, silver appears deeply undervalued. A shift back toward historical norms suggests silver must rise significantly, potentially multiplying in value. Do you think silver will close the gap with gold and return to its historical ratio, or are we entering a new era for both metals? Let us know your thoughts in the comments. If you found this insight valuable, don't forget to like, share, and subscribe for more updates on gold, silver, and the markets. Thanks for watching.